Hello everyone and welcome to the Market Post. Today I'm going to be taking a dive into Tesla's Q1 2020 earning report that just came out on Wednesday. Overall, this earning report is a very good sign for Tesla. Analysts have been very skeptical of Tesla, but this earning report is showing that they are on the right track before illness 19 hit. While looking at the financials, we should keep in mind that this quarter was sort of half impacted by illness 19, and if the lockdown in place continues, the real impact is going to be seen during Q2 earning report, so we should keep our eye out for that. With that said, there are three major takeaways that I noticed in their earnings, and that's mainly what I'm going to be talking about today. The first takeaway is how Tesla is able to reduce its production costs, which will have a big impact on the company. The second takeaway is the long-term production increase that we can expect to see from Tesla. And finally, the third takeaway is their increase in profitability and their cash on hand. So the first key takeaway that I'm going to be talking about is Tesla's ability to reduce their production cost. The first aspect of this lies in their automotive revenue. Their automotive revenue did see a decline from last quarter. However, taking illness 19 into account, a 1,200 decrease isn't that negative at all. It shows that Tesla could have been on track to pass their Q4 sales, and Tesla even said that around mid-March they were having their best quarter yet, delivering around 66,000 units at the time, which is insane. That would show how much further Tesla could have gone to pass the Q4 sales, which would have been the best quarter ever. And their regulatory ZEV credits have also seen a big jump, a 166% jump over the last quarter. And this is helping them reduce their costs because they're essentially getting tax reductions, getting refunded from the government for each electric car they make. And the government does this for every automotive company. They do it for Ford, GM, Chrysler, and anyone else. But the thing is that Tesla is making so many more electric vehicles, obviously, because they're a fully electric company versus companies like Ford, who are just starting to get into that process. So for every car that Tesla's making, they're getting a reduction in taxes, and they're getting refunded, which is seeing a huge profit increase for Tesla. And this kind of ties into the Shanghai factory because China did say that by I think it was 2022, they're going to completely cut out their ZEV credits or reduce it to very little. And they already reduced it this year. I think they're going to do another 10% or 2% or so. Next year, it's going to keep going on until 2022. So secondly, Tesla's gap saw a huge increase. It saw a 20.6%, which is a huge improvement year over year, and is almost a 2% improvement from last quarter alone, even with illness 19. And adding on to this, their operating expenses were reduced by 13% year over year and saw a decline from 8% to 8% from last quarter. This really goes to show that Tesla is learning how to improve their production line to make cars more efficiently and cheaper, which is going to play a huge key in reducing their production costs. And even with the virus, their gross profit almost surpassed that of last quarter, which is incredible considering that historically, Q1 is weaker than Q4 for the automobile industry as a whole. And now the third thing is revenue. So revenue is connected to Tesla being able to reduce their production costs because it allows them to decrease the price of their cars for the consumers. And this aligns with Tesla's goal to make an affordable electric car for the mass market. We see this with their Model 2, if it's supposed to come out, the compact car for $22,000. And this is really a huge deal to them because they were able to they're going to be able to reach a much wider consumer base with a cheaper price for a luxury electric car that some customers normally wouldn't be in the market for, but now that it's at a cheaper price, they can afford to get a luxury car. So that's what I have for how Tesla is able to reduce the production costs, which is the automotive revenue, their gap, and their revenue. So now moving on to the second major takeaway from the earning report, which is Tesla's long-term production increase. So first of all, Tesla's Shanghai Gigafactory is a whole topic of its own, but I just want to touch on it a little bit here because I have to give them some praise for it. So they broke ground on the Gigafactory Shanghai in December 2018, and they were able to finish this by December 2019. But not only did they finish it, they started to roll out 1,000 Model 3s a week by the end of 2019. This is a huge accomplishment for any company, let alone an electric automobile company. In January, we saw this increase to 3,183 Model 3s a week before the shutdown started taking effect. And ultimately, they expect Gigafactory Shanghai to reach about 4,000 units per week midway through 2020. And we know that China is really pressing on Elon to get a lot of cars out by the end of the year, so I think that we can expect this 4,000 units a week to increase by the end of 2020. So I just had to give a little praise to Gigafactory Shanghai for that. So now, the production really amazes me, and this definitely beat what analysts predicted as well. So this quarter, Q1, they saw a huge increase in production rate, being able to produce 102,672 cars. Year over year, this saw an increase of 30%, but more importantly, they were only down 2% from last quarter Q4, which saw a production of 104,891 units. And that was in one whole quarter, which had been the most successful quarter yet production-wise. And this quarter, they were only down 2,000, and half of the quarter, they wouldn't even be able to produce any cars. So the fact that Tesla was on track to outperform the whole Q4 before illness 19 shows how they have been able to improve their production to a significant extent because of their gigafactories. Now, quarter 2 will most likely present a decrease in earnings because of the shutdown, but we can expect to see an increase in their production in the upcoming years. For example, Phase 2 in Shanghai is only going to add to their production rate since it is larger than Phase 1 Shanghai, which is currently producing Model X, like I said. Now, Phase 2 consists of 2 large buildings, which Tesla refers to as 2A and 2B, and these are already coming together. So if Phase 2 is anything similar to Phase 1, which they got built in under a year, we should really hope to see a speedy construction time until it's complete. Because, like I said, China wants to get them going because Tesla's going to be a huge deal in the automotive market over there. And on top of this, Gigafactory Berlin will hopefully be affected by Shanghai's rapid construction, and Elon already publicly challenged Berlin to finish at the same time as Shanghai. So once Berlin also gets going, we can expect to even see a higher production rate for long term. So now I'm going to be moving on to my final and third key takeaway from Tesla's earnings report, which is Tesla's increase in profitability and their cash on hand. So cash on hand right now is crucial for companies that want to survive through the recession, because that's what they're going to be able to take money out of, because they're not making any profits. They have to revert to their cash on hand. So Tesla's gross profit of 1,234 billion is a big step up from last year. This shows a 118% growth year over year. And although this was a 9% decrease from last quarter, this is also similar to the production rate in the sense that they were on track to have an amazing quarter, but illness 19 kind of shut that down. Like I said before, Tesla even stated that it was on track to be one of their best quarters yet. So with their Gigafactory Fremont being shut down on March 24th, and they had to shrink their workforce by more than 75% at the Nevada Gigafactory, Tesla essentially almost fully lost production of vehicles for more than a whole month out of the quarter. So the fact that their sales are being so positive before the shutdown can only give us a glimpse in the direction that Tesla is going in the future with their production. Overall, this is a huge positive for Tesla, and what I think really played a big role in this was that they were able to ramp up production at the Shanghai Gigafactory, which I keep coming back to because it's such a crucial element of Tesla's production, because they were able to make 3,000 vehicles a week, and Tesla expects this to rise to 4,000 by the mid-2020. So you may be wondering why I'm still talking about production when this section is supposed to be about their cash on hand. The amount of production that Tesla can output directly leads to their profit, and their profit is directly related to their cash on hand. Like I said, cash on hand is what's going to get companies through our current recession. For the past 5 years, Tesla has been increasing its cash on hand, showing that even when they were an unprofitable company, they have been able to stockpile cash for a situation like this. And analysts predicted that Tesla would be continuing their upward trend to their cash on hand this quarter, and that's exactly what Tesla did. Their cash on hand increased to a little over 8,000 million, showing a 29% increase from last quarter and a 268% increase year over year. So Tesla could not have been able to set themselves up any better when comparing to their past quarter cash on hand. What this means is while other companies will be pulling from their R&D, suspending dividends, or buying back their shares, Tesla has really set themselves up in a position to withstand longer than companies like Ford or GM. And this is why I believe if automotive companies do go out of business, like Ford or GM, Tesla will be able to prevail and get through this recession. So overall, this is why cash on hand is playing such a crucial part for companies right now, because if they want to survive the recession, that's what they need. So finally, those are my 3 major takeaways from Tesla's Q1 earning report, and that's their ability to reduce production costs, Tesla's long-term production increase, and their increase in profitability, which also leads to the increase of cash on hand. And I just want to touch on one other thing from Tesla's earning report, which is more negative, but I think it is an important aspect to talk about, and this is Tesla's solar aspect. So when people look at Tesla, they think of electric, they think of cars, but analysts don't really look at the solar side of it. And I think that's because they look at car companies as more linear, but when we look at Tesla, we have to look at it as 4-dimensional because it's a new type of car company. And this is also because of their solar. So this was one of the disappointing results that Tesla gave us. Both the solar and storage deployed did show an decrease from last quarter, and although the storage increased from last year by 14%, the solar had a loss of 26%. However, we should keep in mind that solar can go up to $55,000, which is around the same price as one of Tesla's cars. So I did some research, and looking at the overall US installations for the past couple of years of solar across the country, they have decreased recently, with 2019 only increasing by 10,000 installations. While we don't have numbers for 2020, I expect that it will continue to decrease due to illness 19 and solar not being a top priority on people's list to spend money on this year. So this is why the decrease in sales shouldn't be too surprising, since Tesla is following the macro trends of the rest of the country for solar. So I just want to touch on solar for a little bit. And one other thing I want to talk about is Elon's tweet recently. He's been tweeting a lot, but the most important one, or the funniest one, is that he said his own stock price was too high in his opinion, which I think is funny because it automatically sent this from 880 to about 700 like in a day. And I think maybe he did this to get the investors out that are just trying to get in there for a get rich quick scheme a little bit, just to ride the trend of our economy right now. But I think he wanted to keep the investors that are really looking at Tesla as a long-term investment. But the fact that he did this kind of goes back to his situation with the SEC a couple years ago, which I know they've made regulations after the meeting they had, and I don't know if this breaks the regulations that they created. So I'm curious if we're gonna see the SEC to talk to Elon, which could have negative effects on the stock as well. So we should just keep an eye out for that. So that's my video for today, guys. Let me know what you guys think about Tesla, about upcoming stocks. Let me know in the comments. Have a great day.